Next up is Dino Champagne. Dino is Vice President and Division Manager of Asset Preservation, Inc., API, with over 20 years' experience in the Qualified Intermediary industry servicing. Prior to joining API, she spent 14 years as a commercial real estate broker, handling sale and lease negotiations, and 15 years with a major bank as an Assistant Vice President and Commercial Lending Officer. Welcome, Dino.
Thank you. Welcome, everybody, and I'm happy to be here again representing the 1031 space. You've just heard the giant overview about taxes between Matt and Amanda. Now we're going to get into the little skinny lane that I operate out of the tax code, and that's IRC Section 1031. So one of the things I want to bring you up to speed. There's been a lot of confusion about what's going on with the Biden plan right now. How are 1031s impacted by all of that? So let's kind of go what we thought was going to be happening. Then there was a subsequent proposal, and then where we are today. So where we are right now, originally under the Biden plan, 1031s were going to be eliminated. That had morphed over into capping the value of how much tax you could defer. Now, fortunately, right now, under the House Ways and Means Committee, 1031s have been completely taken out of the current proposal. Now, as Karen said when she was doing her presentation, we don't know what's going to happen once it gets to the Senate. So right now, we're safe, but we don't know whether that's going to come back, and then they're going to be looking at possibly capping 1031s or what's going to happen at that point. So hopefully, you know, this is our 100th year as being part of the tax code because 1031s came into effect in 1921. So we've made our century here. Let's hope we continue for another century going forward because it's a wonderful tool for people to help to grow and build their investments. So that's sort of the update right now in regards to what's happening on Capitol Hill and 1031s. Now, we've had a very, very robust market in the 1031 space of late. And if anybody has been involved in transactions, you understand how crazy it's been. The volume, I would say, from a transactional point, from say maybe 2 years ago to right now, we're looking at probably double, triple the volume of 1031 transactions that are being made at this point in time. So there's a lot of transactions going on. So what we're noticing right now, there's pitfalls that people are running into when they're dealing with their 1031 transactions. So those are the things that I want to cover with you today. Is I have like 5 major pitfalls that I see that people can, need to be aware of. So when they're doing this transaction, they can be as successful as possible. Okay, so the first pitfall that I notice is that taxpayers that are doing their exchange are not consulting their CPA and or tax advisor prior to getting under contract with their sale. They're also not utilizing their CPA or tax advisor's expertise in reviewing the closing statements. So let's kind of go over that a little bit and so you can see how it plays out in the 1031 world. When you're considering selling investment real estate, it's important that you talk to not only your real estate professional, they're going to be telling you how much you think they can market the property for. They're going to tell you how long they think it's going to be on market. That's what they're dealing with. But they're not going to be able to tell you whether you should or whether you need to do a 1031 based on your tax liability, okay, or your tax situation. It's so important that when you're considering selling investment real estate, that you not only consult the real estate professional that you're going to be working with, but that you also consult your tax advisor to determine whether you need to or should do a 1031 based on your tax situation. So for example, you may have some loss carryovers, maybe some suspended losses that you haven't utilized. When you're looking to find out whether you need to or should do a 1031, your tax advisor is going to be able to tell you, gee, Joe and Jane, you don't really need to do an exchange because we have all these losses over here that can be utilized against the gain on the sale of this property. If you do not need to do a 1031, then don't do a 1031 because its advantage is that if your tax liability is little or mitigated by any potential loss carryovers, then if you decide to pay what little tax you may owe on the sale of that property, you can still go off, obviously, and buy investment property. And the good news is you get a brand new basis in the new property. So you want to talk to your tax advisor about whether you need to or should do a 1031. Also, it's so important when your tax advisors are looking at your settlement statements. A lot of times in the 1031 space, people are getting these closing statements, the settlement statements, and there's all these expenses that are on there. Well, there's certain expenses that you can write off in an exchange or part of an exchange transaction, and there's some that are not. So, for example, it's not uncommon in today's market where an investor has to maybe rehab the property a little bit, bring it up to speed to make it more valuable for sale. So when that happens, you're paying all these expenses. So it's not uncommon that the investor is going to say, well, can I get my $10,000 or $15,000 back? Well, the question is, if will you get it back without taxes? Well, probably not, because those are expenses associated with either repairing the property or making capital improvements to the property. But if you review those costs with your tax advisor, that person can tell you whether you're going to be able to mitigate that or not based on how they can offset it or what the situation might be. Or they may advise you just let it go, let it roll into the next property. So as you can see, talking to your tax advisor should be the first thing you do when you're considering selling your investment property. Now, the next one is not setting up the exchange in time and failure to properly identify during the identification period. So let's go through a little bit of the basics 1031, okay? When you're doing an exchange, the qualified intermediary, that's my function in the transaction, we need to be assigned into your contract prior to the closing of the sale. Now, you cannot set up an exchange if your sale has already closed. It's too late to do that. Let me also give you a little tip in today's market. Remember I told you that we're looking at 3 times the volume of doing 1031s that we probably saw a year and a half, 2 years ago? Last-minute exchanges are very difficult to set up right now because the timing of getting those documents and everything, because of the volume we're dealing with, physically we're not able to help if you're trying to close on a transaction the same day. Now, 7 months ago, we could have done that. Nowadays, because of the volume that we're dealing with, people are losing out on the ability to do their exchange because they're waiting too late to set it up. So very important to understand the timing of when you need to do this. I like to say that when you're doing an exchange, when you're thinking about it, when you talk to your tax advisor, once you get under contract, to me, you should be talking to the qualified intermediary, somebody like me, to start the process, okay? If the sale doesn't go through, most companies, at least with ours, we don't charge you if you have to cancel your file if the sale hasn't gone through. But now you're at least in position that if the sale goes through, you're not trying to set up a last-minute exchange. So setting up the exchange prior to the closing of the sale is extremely important. Last-minute exchanges are very, very difficult to do right now. Now, another component that we're seeing that there are issues with is people identifying the replacement property. This, for some reason, people still get caught up and they don't understand, well, I'm under contract with the property. Well, being under contract with the property doesn't mean you formally identified the property for the 1031. One of the basic rules for doing the 1031 is that you need to properly identify. So I always like to say there's the technical and then there's the practical. The technical side, when you're identifying, basically means that you are going to fill out a form. That's the formal identification. Says these are the replacement properties that we wish to acquire as a part of our exchange. That's a separate document from the contracts where most people think they've identified because they're in contract with a property. Now, if you close on that property within the 45 days, because remember, you have 45 calendar days to identify what you're going to buy. If you close on that property, it's deemed identified. But if you're just merely under contract, but you fail to do the identification and you close on it after, did you properly identify? Okay, so watch the identification, be aware of that time frame, because people today go, well, do I get any kind of extension because the inventory levels are so low and it's so difficult to find property? And here's the short answer to the long question. No. There are no extensions because the inventory levels are low. The only time that you're getting an extension is if there's been a presidentially declared disaster and you happen to be involved in a transaction and in the area that the disaster has been declared, okay? So understand that once you start with the 1031, those time frames, the 45 calendar days, 180 calendar days, begin at the closing of the sale, and you do not get any do-overs, any start-overs, okay? So just know you have to be very serious about your transaction. I always say that the hardest part to the transaction is going to be the 45 days, because you have to identify what you plan on purchasing. And just so you're aware, you cannot change your list after the 45th day, no matter what the circumstances were. So a lot of planning. You have to stay on top of your transaction. You have to have good communication between your real estate professional that you're working with, good communication with the qualified intermediary, so you're meeting all these timelines and you're meeting these guidelines. Okay, the next pitfall that we see is that, there we go, understanding the requirement for full taxation and financing. Now remember, when you're doing a 1031, it is a continuation of ownership. A lot of times people say, well, don't I just have to reinvest the gain? Or don't I just have to reinvest the cash coming out of the sale? And the answer to that is no, and maybe no, okay? The reason I say the maybe no part is if you had no loans on the property, then yeah, you would have to reinvest just the cash coming out of the sale. But understand the requirements. When you're doing an exchange, to defer the tax on the gain, you have to spend all of the cash coming out of the sale, and you must replace any loans that were paid off when you sold the property. So you're basically buying property equal to or greater than your sale price net the closing cost. Now, a lot of times people will say, well, I want to make sure that I have 100% tax deferral in my transaction. Well, that's good goal, but there may be something on those closing statements that may still create a taxable event, okay? And that, again, brings me back to talking to the accountant, having the accountant take a look and reviewing those closing statements to tell you how you can mitigate or possibly end up with your true 100% tax deferral. Probably more times than not, there's going to be some level of boot on a transaction, but it's not necessarily going to destroy your exchange, okay? Understand what you have to buy. You must spend all the cash, and you have to replace the debt. Now, there are two ways of replacing the debt on the sale of a property, just to refresh your memory, because sometimes people think, well, I don't want to get a new loan. Well, you can replace the debt by bringing in cash from outside of the exchange. So the government doesn't care how you replace it, right? You either get a loan from friendly lender, or you can bring in cash from your savings account to make up the difference. That's how you replace the debt on the exchange. So basically, you're buying property equal to or greater than. Again, you notice I'm emphasizing and spend all of the cash. Now, to the extent you do not spend all of the cash, then that cash is going to be taxable, all right? But maybe it's not going to be taxable too bad, because maybe you have some suspended losses, and that can offset what's called the boot. So another component that we're seeing and noticing that some pitfalls into the 1031 transaction right now is the financing of the replacement property. I think when you're getting in a transaction, and if you haven't been in the financing world in a while, I think it's very important that you start looking as to what kind of financing you're going to be able to get once you're out looking for the new replacement property. Know what your financing criteria is. Have that closing statement show the lender how much cash you have to put down. Because if you get too much of a loan where you're not spending all of the cash, the cash you're not spending is going to be taxable, even though you might have purchased higher than what you sold for. So very important to understand how that works out in the financing in today's market. I also think it's important to understand what you have to bring in from personal funds to pay some of these costs in buying the new property. I'm seeing a lot of transaction right now when people are buying, for example, 1-4s, and the lenders are now requiring impounds. Okay, so maybe they're looking for 3 months of insurance, or they're looking for 3 months of property taxes and such. Okay, how do you deal with that? Do you use exchange proceeds for that, or do you bring in money? Okay, if you bring in your own funds, then because that's an operating expense, you're going to mitigate any tax liability because you've used exchange proceeds to fund the impounds, which would not be a part of acquiring the property. That's an operational expense. All right, so know what the rules are, know how much money you're going to need to have when you're buying the replacement property, because you're going to have inspections, there's going to be appraisals and such. All those things, you should have those monies in reserve to pay those costs as you're going through the process. So know what's required for full deferral, know how, and understand your financing as you're going through. Exchange entities. Amanda and I were talking before this today, and this is one of the issues that I'm seeing. I'm going to use the word epidemic because it feels that way right now. When you're doing an exchange, it gets down to who's the taxpayer, who's doing the exchange. So there's times where people think that there's vesting. So in other words, how you're showing the name that's on title, and then thinking, well, that's the taxpayer. Well, not necessarily. There's times where people start off owning property one way, they change their tax ownership through the course of operating that property, but they fail to change the title, so the vesting is not matching the tax owner. When you're doing an exchange, the same taxpayer needs to purchase from the same taxpayer that sold. So again, bringing to point number one, a lot of times the tax entity, the tax ownership has changed through the course of owning that property, but the vesting never changed. I have several instances right now where a husband and wife are on title to the property. They created an LLC, taxed as a partnership, never bothered changing the vesting. The contracts are reading as the husband and wife. We find out the tax ownership is the partnership, not the husband and wife. And so now what do? Now they have to deal with that issue. These are things that can be dealt with early on, even before you get under contract. So know who's the tax owner doing the exchange, understand the rules of who has to buy from who sold. You cannot change taxpayers in the middle of an exchange. Very important to understand, again, who's the tax owner. Okay, now the fifth is, and we're seeing this a lot right now, there are people that are buying new construction. When you're purchasing new construction as a part of an exchange, you have to look at the timing of when that construction is going to be built, okay, when it's going to be completed. Because there are transactions right now where investors have gone under contract with the replacement property, which is new construction, well in advance of, say, selling their relinquished property. That's okay, so far you're good. But what's been happening because of material shortages, labor shortages, and such, these properties are not able to be completed in time for the exchange. I used to say that, the hardest part to the exchange, and I said it, I'm not going to change that statement, the hardest part is going to be the first 45. And then you have another 135 days, right, to finish your exchange, encompassing the full 180 calendar day period. But now, because construction is taking so long, we're having exchanges that are barely getting to the finish line, and some are actually failing because the construction is not complete. There's financing that they're getting to buy the replacement property. The lender is not going to close without a certificate of occupancy. There's not going to be a certificate of occupancy until it's complete. So people are actually running into these challenges right now, in the 1031 when they're buying new construction. So my advice is when somebody's considering new construction as a part of the exchange, that they're either planning this well in advance, that they're getting under contract with that new construction, where by the time their property gets under contract and closes, there's minimal amount of time left to have to finish that building. So, very important issues when we're coming to an exchange, because even though the building isn't complete, no fault to the taxpayer, okay, probably no fault to the developer because of all the material shortages that we're dealing with right now. The IRS is not granting any extensions, so people are losing their exchanges if they cannot complete it within 180 calendar days. So these are the issues and the pitfalls that I'm seeing in today's market. So what I recommend is that when somebody is considering going into a transaction that's involving a 1031, very important to sit down with your tax advisor, even before you list the property. If you're thinking about selling it, sit down with your tax advisor to determine, do I need to do a 1031? Or can I do a partial 1031? Is my vesting on title to my property matching how my tax reporting is? Because those are issues that can be addressed in advance of you even listing the property. Once you get under contract with a buyer, understand your time frame for the exchange. Be proactive in your own transaction. You cannot rely on the accommodator reminding you every step of the way or your real estate agent reminding you every step of the way, okay? It's your initiative. It's a taxpayer initiative. You're entering into a real estate transaction, but when you do a 1031, you're also doing a tax transaction, okay? So be aware of the time frames. Watch all the moving parts. Remember when your 45 days is. Remember when your 180th day is. Now, we send out notifications to people, but you should, if you keep focused on these dates and understand, you know, then good communication between you and your qualified intermediary and your tax advisor will definitely help throughout this transaction. Make sure that you sign the exchange documents prior to the closing of the sale. There's times where people get the exchange documents and they don't sign them. They think, oh, well, I got the documents, I'm good to go. Well, they're not active until you sign them, okay? So make sure you're signing the documents. Get your identifications in on time. Understand how much you have to spend. Make sure your closing is going to be done. Again, good communication. When everybody's working together, 1031s do not have to be scary, okay? It can be more of a treat as opposed to a trick. So anyway, keep that in mind. Stay engaged in your transaction. Have good communication, and your success rate for doing a 1031 in this market will be pretty good, pretty high, okay?